know we had a couple questions come in. Maybe we get to those, and then we'll get back to Vernon's presentation.
Absolutely, and this one is for you, Erik. And there's a question from Scott Langford that interesting work. Do you see differences across race? You focused on low income. So the question is both from the bank side or in the sense that minority deposit institutions or on the borrower side. So any comments on that?
I think that's a great question. So I have other work that actually looks at race and lending. In this paper, I haven't looked at it yet, and part of that was when I first went and got the data from Chetty. They didn't have it split out by race, but just a few months ago, they released a new version where you can actually look at upward mobility by race. And so I think you've basically touched on a research idea for a paper in the future, which would look at the development of financial institutions in various areas, or potentially competition, things that could root out any discrimination in lending or just reduce access to financial services for minorities, and look at how that would affect long-run outcomes from and contribute to racial inequalities in the U.S. I think, and minority depository institutions would be pretty interesting to look at there as well. So I think that's basically the start of a second research paper, which could be really interesting.
And Jim, I do see Alan. Roger, if Alan, you're still here, please go ahead and ask your question to Erik.
Okay, I never go away. I'm always here.
I know. Good to hear your voice.
Right. Thanks very much. Listen, my first comment is both of these papers are really quite good. I'm very impressed. I'm really glad the tradition of looking at small banks is continuing with the young people, and that's great. So, but I'm going to make 3 suggestions. These are not necessarily for these papers, but maybe for future research that could enhance these. One is just a very simple suggestion: is talk a little bit more about policy. So we have large banks and small banks, but there are many policies that can be pursued that affect the amount of small banks and large banks in the country. I won't go into them because there's not time for that. The second comment is I'd like to. I'm getting feedback. The second comment is that I'd like to see papers that look at good times versus financial crises. Yes, making loans during good times, they all work out. Everything is great, but really, we need to see the differences between good times and financial crises. And there's no better time than now with the COVID-19 crisis to actually see some new results. And the third suggestion is I'd like to see broader sets of outcomes. So yes, getting a loan and everything is great, getting a lower interest loan, but small banks and large banks differ in many ways. So large banks might provide higher deposit interest rates. I believe that's actually generally true. I think large banks might be better for your large employers, so you may get employed by a big employer and so forth. So I'd like to see it a broadening out of some of the outcomes. You can look at hiring by different firms locally. That's all available. And if I can just put in a quick plug, I do have a paper coming out that uses it looks at differences between large banks and small banks in how consumers answer the University of Michigan Survey of Consumers. And there's some very big differences. I won't tell you what they are because I want you to look it up for yourself. It's coming out in the JMCB. It may actually be out yet. I'm not sure. Okay, let me leave it at that.
Thank you, Alan. Thanks a lot. And these are great suggestions. Erik and Dayin, you want to respond to the suggestions that Alan gave? Erik?
Sure. Yeah, I think those are great suggestions, especially looking at the policies that would differ for large and small banks. I guess I am looking at the differences in regulation, but I should also consider as much as possible other policies that are going to differ. One of the things that I find is that, so a lot of these policies would have emerged after the financial crisis. something I've looked at is that the further you go back in time, actually the difference between small bank and large bank lending stays at least as large going back in time. And the effective distance gets larger as you look further back in time, which I think makes a lot of sense if this is an information story. I do think that even the small banks are transitioning to using less soft information than they might have 20 years ago, right? But so yeah, those are two patterns I think that are interesting that kind of speak to this a little bit.
Yes, I totally agree with Alan, and I just want to, but I just want to circle back to Amiyatosh's point about the liquidity mismatch of that Federal Home Loan Bank potentially can create to the whole system. So first, before I just look at how, just show you how I view this question, I just want to make sure that I want to, this paper is trying to divide this whole Federal Home Bank into like two questions. First, that it gives some support to the small banks and how does that affect the competition structure of the whole market. And then Federal Home Bank has its own balance sheet. It will find its way to fund itself to lend to the small banks or big banks. And then there might be problem, as you pointed out. They borrow from money market funds and then lend to the member banks. I think this has been highlighted by a paper by Kai-Rong Xiao and his co-authors, and they look at it very carefully. So I just here this paper, I just want to focus on one point, that if for somehow we just provide some liquidity support to the small banks, how does that affect the whole competition? But as you pointed out, this is all done by Federal Home Bank, and how does that affect the whole market? I think this is very interesting. And I think I have talked to people in Federal Home Bank. They think lending that now more big banks are borrowing from Federal Home Bank is good to both Federal Home Bank and the small banks. And then they can just increase their volume, their bargaining power, so they can just have more liquidity to lend to their small members. That is one benefit. But also there is disadvantage that it might create some systematic risk, like the liquidity mismatch. So it is a mix. I need to think more about it, and we need to put more structure on the model to think whether the net is benefit or disadvantage. And also another big change, or potentially big change, could have happened if there was no COVID-19 crisis, is that in a recent housing reform plan published by the Treasury, they proposed to let the Federal Home Bank lend to the non-banks, which we know now is growing very large, taking about 50% of the mortgage market. And that is a big structure change if it happened. I'm not sure what will that mean to the whole market or the small community banks. And also that is the next, the future research of my agenda.
Thanks a lot, Dayin, and a lot, Erik.
Can I just circle back to a quick point really quick?
Absolutely.
Okay, so I want to make two quick circles. So one was back to Vernon's discussion. So I just want to say that I do look at both the conforming and non-conforming markets, and the results are actually stronger in the lowest income where it might be non-conforming. And then I wanted to go on to Amiyatosh's point about fintech, and I actually think that that's one of the most interesting questions of the next 5 or 10 years to look at in this area, is how whether fintech can provide new credit using this additional information to the lowest income borrowers, or whether they'll compete mostly on cost versus big banks. I think that's sort of the frontier of what we should be looking into going forward. Thanks.
Thank you very much, Erik and Dayin, and also Alan. I'll just circle back to Alan's question for Dayin, that it talked a little bit about good times versus bad times. And of course, there are small banks and large bank differences here. And once you start thinking about the liquidity risk aspect of FHLB, then the good time, bad time difference kind of becomes important. So this is not to say that your paper and your model has to incorporate that, but something to keep in mind that in a big picture sense, there is a whole lot going on in addition to these differences. And to be sure, both Dayin's paper and Erik's paper, I mean, you are identifying at a very local level, and you both have done a great job on that. So I see that we have just about 30 or 40 seconds left.
Can I say something again?
Yes, absolutely. 30 seconds.
So I hate to always be advertising my papers, but I actually have a paper on the issue of whether fintech substitutes for the soft information of small banks or the hard information of large banks. It's actually on the SSRN now with John Hackney and Balyuk, and it finds actually the fintech substitutes more for the large banks, not for the small banks. So I'll just leave it. I know you only have a few seconds left, so I'll leave it at that.
Absolutely, and right here in Michigan, when we look at the expansion and the growth of Quicken loans, that does comport well with what Alan just talked about in the way they have captured market share from large banks. But we have to stay on time. I know Jim has issued me a pretty strict guidelines. They're not as sharp at 3. But let me just conclude by saying that this has been an excellent session. And I hope that these two papers collectively have shed light on how small community banks can expand supply of credit for folks who really need it the most. And at the end of the day, if we think about the value at a social level that banks or intermediation can add, this sounds encouraging.